if there is anyone. Oh, now you're sharing your screen again.
There we go. Did you want me to share my screen?
No, not yet. No.
Oh, okay.
Yeah.
Stop sharing.
So first is letting everyone in.
Oh, perfect.
Are they coming in?
We've got 7 participants.
Okay.
Do I have to actually allow them in or?
Yes, you have to allow them.
Invite attendees.
Accept. Yeah.
Allow to talk or?
So
the only options are allowed to talk or more, which is chat, promote panelists, rename, remove.
No, that's fine. As long as they're showing as participants, then they're in.
Oh, okay.
Yep, people are in. Hello, everyone. We're just going to begin in a minute. We're just waiting for a few more attendees to sign in. We are on COVID time, and many people often get delayed in their previous webinars and Zoom meetings, so we usually wait 5 or so minutes before everyone gets on. We hope you're all having a wonderful day and that you're enjoying the weather wherever you are. We'll just give everyone just a few more minutes to log in, and
do you have visual on the logins?
I do. I can see the participants, but they come in. You're welcome, David. You're welcome. So if everyone will hold for just a little bit of housekeeping. If you have any questions, make sure that you put them in the Q&A so that we can answer those as we finish up and go into the Q&A session of the webinar. So again, we're just going to give people just a couple of more minutes to log in as we all are experiencing Zoom and webinars, and they often run over. We wouldn't want anyone to miss the beginning of this very important joint webinar between Restaurant and Catering and CPA Australia. And feel free to say hello in the chat box. We see those pop up so that we know who is here and ready to listen to very important information about insolvency. Oh, there's my good friend, Paul. Hello, Paul. Good to see you. Okay, well, it's nearly 4:05, so we're going to begin. Thank you all for joining Restaurant and Catering and CPA Australia in our insolvency presentation, the myths and the processes of the insolvency situation for businesses that are faced with COVID-19 downturns, and dispel some of the myths, but also to address the stigma of declaring administration and potentially going into liquidation and the entire insolvency process. I'll be joined today by Dr. John Purcell, Policy Advisor, Environmental Social Governance at CVPA Australia, and Shabnam Amirbeaggi from firm Crouch Amirbeaggi. So Shabnam is going to start with her presentation. John's going to start with his presentation first, I think, sorry, and then Shabnam is going to finish up. So take it away, John.
Thank you, Wes. Just some introductory remarks. The intention of this presentation and discussion is very much around information sharing, engagement, seeking to bring participants in this webinar up to speed on what can be some rather daunting rules within corporate insolvency. You stress that many of these are reasonably complicated areas of the law. Nonetheless, they are there to assist and guide businesses and protect the interests of creditors. It is an information session, and particular matters which may relate to your own circumstances, we would certainly urge you to seek independent professional advice. As to repeat, our session here today is very much around information sharing and seeking to appraise you of some of the not necessarily more technically complicated areas, but help you understand what's out there to assist and guide you through these very, very complex times. So with that, it's my pleasure to hand over to Shabnam.
Thanks, John. Good afternoon, everyone. Shabnam, or Shabby, if you like. It's easier to remember. I just wanted to kick off by saying welcome and thank you for your attendance today. As John's mentioned, it's an opportunity for me to share some of my experiences with the crowd and hopefully have some opportunity to answer some questions. So, I mean, as if small business didn't have enough challenges in survival already, and now we throw in a pandemic, the bushfires, and we throw in forced shutdown. So, you know, it's been a turmoil of a year. But I think what we've got to remember is that we've been doing this now in this sort of time pattern for 10 months. And I think the focus, what I'm trying to encourage businesses to do is to move away from the focus of the wait and see attitude and move towards a plan for what I'm going to refer to as the new norm, which is, you know, you go to a restaurant, you sanitize your hands, you check in, and you have social distancing. And, you know, you want to make sure you abide by the government guidelines so that you don't have any fines and things like that. So hopefully by the end of today's session with John and myself, we will encourage you to seek some advice earlier rather than later, and start planning for the future rather than waiting to see what happens. I'm a trustee in bankruptcy and a liquidator with over 20 years experience, and insolvency and reconstruction is all I do and am passionate about. So I could talk about this for hours, unfortunately for some. Just topics of discussion today that I'll run through with John are the temporary insolvency relief measures that are around at the moment. A little bit of information, I'll touch on the Small Business and Family Ombudsman's inquiry into insolvency. And the reason I do that is just to fit in with the insolvency regime that's the new framework that has been proposed that might come into legislation. I'm hoping to leave you with the thought process that we're not the Grim Reapers as we are thought to be. The perception is we are here to try and help you, and by we I mean liquidators and administrators, insolvency practitioners. And I also will touch on some of the new legislation that's being proposed as well. So most of you will probably be aware, and if you're not, the temporary insolvency relief measures are as per the slide. And they were intended to be just that, temporary. So they were meant to end at the end of September. They were extended mostly as a consequence of the lockdown in Victoria to be extended to 31 December. And the importance of these provisions is that for businesses who are chasing debt, they can't chase the debt unless the debt is over 20,000 now for a stat demand and 20,000 for a bankruptcy notice. And the debtor has 6 months to comply with the stat demand or bankruptcy notice, which is quite a significant increase in the amount of time usually provided, which is 21 days. And the biggest relief that we see from our perspective as insolvency practitioners is the director's relief from insolvent trading, which essentially is allowing directors of companies to continue to trade or incur debt whilst the company is insolvent. And that's a pretty big deal. It means that, you know, at the time when the company is then finally placed into liquidation, there isn't that the period between March to December is carved out, and the liquidator can't pursue a director for insolvent trading. Now, the reform on that, which is important to note, is that it doesn't cover dishonesty and fraud. So directors have to make sure that the debt is incurred in the ordinary course of business. It has been incurred during that period, which is the March to December. And EU and the recent law, not recent law, the recent interpretation of the law is that an external administrator, being a liquidator or a voluntary administrator, needs to be appointed to that company before those provisions end. There has been some discussion about the provisions being extended potentially through to 31 March. And that is only at this point a discussion, and it's only going to be available to companies who file an intention to appoint a liquidator or put forward a proposal to their creditors under the new legislation. So that's a little bit of a watch this space sort of thing. Just a little slide on some comparisons which is probably a good thing for you guys, to see that the numbers of insolvencies has dropped dramatically as a consequence of, we feel, the government stimulus that's been offered, JobKeeper, the cash flow boost, and also coupled with the rent relief provisions. And also the insolvency provisions have basically seen a dramatic drop in the appointments, 90% down in wind-up applications, and 60% down in administrations. The problem that I see as a liquidator in those numbers is that it can't possibly be that there's that many businesses that are solvent and don't need to be wound up. So it's very much what we feel is the directors are doing a bit of a wait and see approach. They're not taking any active measures, and they are just collecting the government stimulus and hoping that that when they come to an end, that they will then be able to place a company in liquidation. The issues with that is that your options become quite limited in terms of what the outcome would be for that business. It's important also, before I move on, is that creditors are taking a majority of the risk at this point. Obviously, they're trading with companies who are coined the zombie companies, which are companies that are effectively just incurring debt and then plan to shut down come 1 January, which is a big risk for creditors. So there's many different options, both formal and informal, that you as a director could potentially avail yourself of. These are just some of the more popular options that I put on this slide, of the formal Corporations Act options that come forward. And the type of appointment that is recommended by an insolvency practitioner is generally guided by what the director seeks as the outcome to some extent of that business. And there's a massive difference in terms of how those processes work through, both in cost and in time, and also in the future of the business. So, for example, if you wanted the company to continue to trade through the temporary lack of cash flow that you've got, what you would opt for is a voluntary administration, which then falls into what's called a deed of company arrangement, which is a proposal that you as the director put forward to your creditors to accept, so that and if it's voted through, then those creditors, then that company is handed back to you as the director, and you continue to trade out of that potential insolvent moment. So the key is that seeing somebody and getting advice on those options sooner rather than later is really important to which options are available. Coming to see a liquidator doesn't necessarily mean that your company is going to shut down. I know many liquidators or insolvency practitioners who, it's all the same. Insolvency practitioner is just a word to encompass all the different words that you could call me, liquidator, administrator, deed administrator. I'm an insolvency practitioner, and giving call to someone like myself doesn't necessarily mean that I'm going to liquidate the company. There might be other options. You may come to me soon enough for me to be able to negotiate the debt out with the ATO or your supplier, and then continue the business. But if I'm not there early enough, it kind of limits your options down to literally pretty much closure. So I've just got a couple of stats here for everyone to have a look at, which basically indicates that what I want you to take away from this is, of the 350,000 businesses that start, after about 3 years, 54% of them shut down. When I say shut down, that doesn't mean they get liquidated. 8,000 companies roughly get liquidated per year. So a lot of small businesses or businesses shut down naturally as an orderly exit and just decide they don't want to continue to trade. And I've just put the stats in there for bankruptcy as well, just briefly. I didn't want to go into bankruptcy much today. So the ASIC stats, which are collated from reports that we put together as liquidators for ASIC, indicate that inadequate cash flow or high cash use is the biggest reason for failure of business, and the other two being poor strategic management and trading losses. What's important there is that with a broader brush, because the ASIC reporting is somewhat a bit of a ticker box for us. So the University of South Australia has undertaken a study and they've indicated their reasons for failure. The important one for the SME space that we see a lot is the mismanagement of finances, and the lack of leadership, in that most small businesses don't employ somebody to manage their books necessarily all the time, and that's as a function of just not having enough funding to be able to do that. So they try and do everything. They've got three hats on. They try to become the seller, the employer, and the admin person and the accountant at the same time, and all those balls in the air just don't work. So I've just got a couple of warning signs for insolvency, and I'm hoping you're looking at this slide and not mentally ticking off things that you can see in your business. If you are, I strongly suggest you seek some advice either from your accountant or an insolvency practitioner. So the important thing about these warning signs of insolvency is that most people who are directors of a company, small business or not, what they don't normally see is that you're actually potentially exposing your personal assets as well. There's a lot of times when obviously directors sign personal guarantees, for example, or ATO debt in the way of PAYG and superannuation guarantee, and also GST as of 1 April 2020, can become a personal liability. So it's important that directors remember that the company structure doesn't necessarily save your house. If you don't get advice earlier, when you start to see some of these things on this screen happening, the options of saving the business or potentially saving your personal asset position are somewhat limited. I want to just touch more on the ATO side of things. I'm hoping that most people are only theoretically aware of what a director's penalty notice is rather than actually having seen one. The ATO has the option to issue a director's penalty notice to directors of a company for company incurred debt. And what that means is that you as the director could potentially be personally liable for the company's debt. And the way that the ATO can recover that debt then is from your personal assets. So that means either bankruptcy, garnishing your wages or your bank account, or pursuing the debt in other forms. So withholding tax refunds from your personal income as well. So if you see one of these sort of notices, it's important to have a chat to your accountant. Make sure you give the options to your accountant to be able to negotiate a payment arrangement or potentially wind the company up and avoid that personal liability. So I think that generally why in the SME space, and by the SME space I mean they're defined by the Australian Bureau of Statistics as having employed 19 employees or less. And for your industry, that represents about 92% of your industry falls within the SME space. And I'm talking about over 45,000 businesses in the restaurant and catering industry. So when we talk about your SME space, we're talking about a large number of stats in terms of Australian business. Just generally, 98% of Australian businesses is in the SME space, and it's emotional. There's an emotional attachment to the business generally. It's your key person, operator. It's the person that started the business with passion, enjoyed whatever they did in terms of like real hunger and passion about it, and then set up a business and hope that it would survive. It's not generally the sort of person that has available to them all the different areas which in a big company, you have your board of directors, you have your HR manager, you have your tax obligations reporting person, you have, those sort of things don't necessarily happen in a small business. So as a consequence of with the issues with small business and the focus on small business at the moment, the government's got a massive focus on small business and how they will or won't survive in the post-COVID lockdowns and all that sort of thing. And what came about from that was the Small Business Ombudsman inquiry into insolvency, which actually started late last year, which allowed for its small business operators to put forward submissions to share their experiences with the insolvency framework or the insolvency practitioner, and people were encouraged to give their feedback. And what it involved was basically dealing with collating information from different stakeholders, the ATO, banks, small business operators, insolvency practitioners, to figure out if the current insolvency framework is sufficient enough to get the best return for all parties involved, if in liquidation was the scenario that was the outcome. And that includes the business operator. So no surprises here. Most of the submissions were negative, obviously. In fact, I think all of them. I was actually one of the members of the committee on the Small Business Ombudsman's reference group. So I was heavily involved in terms of the collating and the and giving back of the feedback. And these are the most often reasons that people put forward in terms of their negative experiences with the insolvency industry. And it's sad to see, the loss of control, the high costs that are involved in the insolvency framework. And there was a real thought process that nobody really cares about preserving the business, which is disappointing to read. I think I've mentioned the stats on the small business and what a small business operator means. So I'll jump through that one. What I want to just, I guess, hone in on with this stat is that 58% of companies that are placed into liquidation have less than $10,000 in assets. So that is really important in the SME space, because the issue is that most SME operators, most directors who are operating a business such as yours, don't have the money to seek advice or to place the company in liquidation. So what they end up doing, or most of the time, is trying to operate through it, kind of push it aside, push the issue aside until it gets to the point where we're suddenly faced with a director's penalty notice or a creditor stat demand, and we're in a reactive mode rather than a proactive mode. And the problem there is that what you generally would do in that situation is jump online and try and see what advice you can find on Google. The issue with that, of course, is that most of the advice on the internet is unregulated. And so, you know, we see messages, and insolvency practitioners and legal practitioners can't compete with people whose business it is to put messages up such as, I will make your tax debt go away, let me hold your hand and walk you through this. Because at the end of the day, we're trying to get the best return for creditors. But when you see the stats, which is 58% of less than 10,000 in assets, it's in no one's interest for that business to shut down. Our first and foremost aim is to keep that business operating. And if we have a think about our cafe, our local cafe, or our favourite Italian restaurant for a moment, if you come and see me as a director who has that sort of a business, and you come and see me once, you've got no cash in the bank account, you've already been served with a stat demand, you're in rental arrears, and you're already, you know, the doors are locked and people are already on COD, your suppliers are on COD, there isn't really much I can do with that. I can't, like, literally, there is no money in the bank account to continue to trade. My only option at that scenario is basically to shut it down, really, and hope that the landlord pays for the assets, because the value in that business is not in those tables and chairs. It's not in the kitchen equipment that's been fixed to the wall. It's in you. It's you're the operator. You're the key. You're the asset. And without you, I don't have much to sell. So seeking advice early when, you know, you've still got the cash at bank and you might be a little bit dipping in cash flow, but there are options in terms of, you know, informal moratoriums or seeking proposals from creditors to give you some breathing space. Coming to me at the end doesn't really give me that option. People are already too angry, they don't care, and it's too hard. Experience that I've had in many restaurants that I've been liquidating, unfortunately, it's always by that stage the key staff have left, they haven't been paid, you know, and a restaurant is only as good as your key people that are there to help keep the kitchen running and the services provided, really. So what we identify as in from the reference group is that what we think is that there's probably, as you can see, some of the comments on this screen are taken from those submissions. It appears that there's a really a lack of or limited understanding in what the insolvency framework means and what it involves, and that's potentially our fault as practitioners, where we haven't explained the situation as best as we could. But I mean, to be fair, when you come to see me, I don't know much about your business. I rely on you and I give you advice based on what I'm provided. And with that limited information, I hope that I save it. And but things come out of left field and sometimes it doesn't pan out as we hoped it would. And sometimes it can get ugly and quite costly. But what's important is that sort of advice you can't really get from just your average Joe on the internet. The insolvency practitioners, both legal insolvency practitioners and liquidators or people that specialize in insolvency, have a real niche understanding in terms of exit and restructure and negotiating and commerciality. Those sort of things are things that we do and do well. And that's the reason why someone in that sort of situation is best suited to come and seek advice from someone of that caliber, rather than just Googling it and hoping that you find somebody on the internet that's going to help you avoid your tax debt, which is obviously not ever a good outcome. So what we're trying to do, well, what I'm hoping you'll take away from this is that we're not the undertakers. We hope that we want to save your business. The insolvency industry welcomes the new legislation if it's brought into effect. It's really great legislation in that it will provide a more simplified and hopefully less costly framework for small business to operate under, or to allow themselves to use the insolvency framework. And we hope that, you know, it will encourage people to seek advice earlier. So, John, I'm going to hand over to you for the biggest changes in almost 30 years in insolvency.
Yeah. If you would just throw to the next slide. Thank you. The Treasurer has announced changes of probably now, would have been about 3 weeks ago, are quite significant. They are to a large degree prompted by the economic circumstances that we find ourselves in, but moreover, you know, as Shab has explained, a view that a one-size-fits-all corporate insolvency system is not operating in the best interests of SMEs in particular. Shab has described the voluntary arrangement, deed of company arrangement system. It tends to work at the larger end of corporations, larger scale corporations, which have a degree of complexity and complicated relationships and assets, which make them more readily capable of entering into restructuring. The model that we are moving towards as applicable to the SME sector, and both the revised restructuring arrangement and the simplified liquidation pathway apply to companies with debts of less than $1 million. There has been a degree of, I suppose, discussion around this idea that we're moving to a US-style debtor in possession type corporate insolvency system. Essentially, the contrast between the insolvency system here in Australia and that which is most typically pointed to as having a strong debtor in possession orientation, that is the USA and its Chapter 11 arrangements. Our system tends very much to see the control of the business, the control of the company, shift from the directors to that of an insolvency practitioner, who then manages the process going forward, with the directors, to repeat, stepping aside. The notion of a debtor in possession arrangement in Australia comes partly from the perspective that it is the directors, the owners of the company, who have a better understanding of the business and how that business might be restructured in a manner to move forward. Nevertheless, there are a number of cautionary remarks to be made about the proposed system, which is in draft legislation at the moment. As a piece of law reform, there is a great degree of uncertainty around the details of how this is actually going to work. a lot of the rules which will be put in place in relation to the new restructuring arrangements will be actually developed in the coming months by way of regulation released progressively by the Commonwealth Treasurer. What is fairly obvious and certain is that the new system that we are moving to for SMEs in financial stress is that it does, in a number of regards, look very similar to the voluntary administration arrangements which exist under the Corporations Act, though with a degree of streamlining. And a number of points to emphasise. It is available for companies who are insolvent. They are unable to pay their debts as and when they fall due. And reiterating one of the points which is really important in all this, a lot of the work in terms of saving companies should happen at the front end before these arrangements have to be called upon. So CPA Australia and a number of other bodies are strongly advocating assistance to be built around business viability assessments and how we can fund better that type of early triage before you have to go to the insolvency doctor and work out what the surgical solutions are going to be. But I've got to emphasise that there is distinct thresholds between this business viability advice and insolvency advice, and in particular, the emergence of pre-insolvency advice that would advise company directors who are in financial stress to engage in activities which are essentially illegal, primarily phoenixing operations where assets are stripped from a company and put into a new vehicle, deliberately to avoid the legitimate claims of creditors. And that brings me to really what is still the essence of the new restructuring arrangement. The company, though whilst in a debtor in possession type arrangement, the company still nevertheless must meet the requirements to enter into a restructuring of its debts with the agreement of its creditors. The creditors still remain central to this part of Australian corporate insolvency law, but the company directors are allowed to have a much more hands-on involvement with how the arrangements are going to be structured. There are a number of streamlining activities, particularly it lessens the cost burden associated with meeting these arrangements. Then I'll get on to in a little bit more detail the insolvency restructuring practitioners who increasingly will be brought into this domain. It is designed to look more quickly at the identification of a restructuring plan. The company, the business restructuring practitioner with the directors collectively enter into a period of 20 days where they identify what the restructuring will look like. The proposal is then taken to the creditors, and the creditors again have the capacity to approve or not approve the restructuring of the debts, allowing the company to move forward. The threshold is for a 50% agreement from unsecured creditors to approve the restructuring of the debt arrangement. Importantly, across this time period and moving forward, it doesn't do away, obviously, with the capacity for secured creditors to execute their powers over assets in due course. That power still remains and needs to be recognised. Importantly, in relation to one of the major creditors in this, and that is employees, employee entitlements need to be fully met as part of any of these arrangements. I've indicated also that there are sort of anti-abuse measures associated with this proposed new system. It is only going to be available on a limited basis, that a director will only be able to use it once over a defined period of time. So it is not something which can be habitually used as a basis for continually restructuring, or indeed, at worst, seeking to avoid the legitimate claims of creditors. I've mentioned the very strong rules which have been developed recently in relation to phoenixing activities, and there will be measures to make sure that these new arrangements do not in any way allow the engagement of a company in illegal phoenixing activities. Importantly, as we've emphasised, there's the reality that at some point, reasonable decisions have to be made as to whether the correct path is one of moving the company quickly as possible to liquidation. And what is also being developed as part of these law reforms is a more streamlined process of company liquidations, again, to repeat, for companies with debts owed to creditors of less than $1 million. There will be a reduced emphasis on the capacity of liquidators, and it will be conducted by company liquidators to pursue what's termed unfair preferences. So these are commercial transactions which take place in a period of around about 6 months before the company entering into liquidation. There'll be less emphasis on the clawback of those, what generally are commercial type transactions taking place in the twilight before actual liquidation. Less emphasis on the obligations of the liquidator to report back to ASIC particular types of suspected wrongdoing. Nevertheless, there are strong measures still in existence there, which if there is obvious wrongdoing on the part of company directors, those matters will be reported back to ASIC. A lot of the streamlining around this will be speeding up the period over which the insolvency takes place. So there'll be quicker processes for both the admitting of claims against the company, that is the claims which creditors are required to prove as what's owed to them as part of the liquidation process. Those processes will be sped up, and likewise the process for paying out dividends to creditors will likewise be sped up. Wanted to address the final point about the increase in the number of practitioners available to do this. Correct me if I'm wrong, Shab, there's probably presently in Australia around about 600 registered company liquidators. So it is not a deep, large pool of practitioners to do what is very significant work from an economic perspective. We do not anticipate a huge influx of what will be small business restructuring practitioners. A couple of points to note around this. Registered company liquidators obviously will be able to do this small business restructuring, but there will be a cohort of practitioners who are able to do the small business restructuring, but not the other aspects of corporate insolvency, such as the liquidation process and voluntary administrations, and act as receivers. Importantly, as the number of practitioners increase in this area, there is realisation that there is a need for these practitioners also to have an understanding of the wider structure of corporate insolvency. So there will be an expectation of a degree of familiarity with both corporate law and specifically some of the more detailed aspects of corporate insolvency law, though without the necessary depth of understanding. So it doesn't operate in isolation from other corporate insolvency, so a level of awareness is needed. The professional bodies, CPA Australia and others, are mindful of the risks associated with opening up too much and attracting into an area of economic significance practitioners who are less qualified or do not understand the real demands of what's going on. The way in which we see this being handled is that the responsibility will still fall on ASIC to recognise these new practitioners, and they will, as we understand it, have a sped up process to approve effectively tickets for these practitioners and also manage the particular expectations around how these practitioners are supervised within firms or supervised in so much through ASIC regulation, looking at their professional qualifications, their carrying of professional indemnity insurance, and the necessary processes which fall in relation to quality assurance within the practices and processes for discipline to make sure that those who work in this area are exited expeditiously as possible as a method of protecting the larger economic and public interest. That really is it in a nutshell, other than to stress one of the points which Shab was discussing, and that's the capacity to avail of these particular arrangements. Now, as has been explained, the temporary measures around statutory demands and relief from exposure to director liability for insolvent trading end at the end of this year on the 31st of December. Companies are nevertheless able to notify early of their intention to enter into these new restructuring arrangements, and through that, as we understand it, be able to seek the protection around relief from insolvent trading for a further 3 months into 2021. But that action needs to be taken prior to the end of this year to indicate the intention that you seek to enter into these new forms of restructuring. And across that 3-month period, it is expected there will be a build-up of available practitioners working in this area to assist the SMEs. But it's important to identify early the intention or otherwise to use these new arrangements. Now, the new arrangements can be entered into any time into 2021, but it's important to note that you won't be able, as we understand it, to avail of the relief in relation to insolvent trading.
Great, thank you so much, John. We do have a few questions, and I know, and cognizant of time, and we have 10 minutes left. So first off, multiple people in the call would love to get a copy of the slides. So if Shabby, if you're amenable to emailing those over to us at Restaurant and Catering, we will most certainly provide those to anyone who shoots us an email.
Sure.
You can send the email to, if you're on the call, you can send an email to me, wes@rca.asn.au, wes@rca.asn.au, and I'll get you a copy. So that is answered. The next one is, Does secured debtors refer to bank loans and equipment finance loans?
Yes. In a nutshell, yes.
Okay, so bank
Yes, sir.
loans and equipment finance are secured.
Most of the time. There are some bank loans that can be unsecured, but traditionally bank loans are secured. And asset finance loans are secured against the asset.
So Shab, this also covers assets which are registered under PPS?
PPSA, yeah. The Personal Property Securities Act.
So we have a question here from Paul, my good friend. He says, I'm not going to read the first half of it, but he says, is restructuring talking about the debt and finance or the business operation itself, or both?
Both, depending on what the option is. So it's very much a case-by-case basis. There's options of restructuring in all various forms, depending on what we're presented with.
And then his next question is the typical fees for an early advice consultation.
Most liquidators will give you 30 minutes of their time for free to have a chat and figure out if there's options for you. Okay.
And then on from there, it's specific to each individual case?
Yeah. Then it becomes an engagement, and then and this new reform is going to be great for the small business space because it's supposed to be a reduction in costs. At the moment, as a liquidator, I do exactly the same statutory-wise in a small cafe as I would do if I was a liquidator of Virgin. The reporting's the same and all that sort of stuff. So the simplified framework will hopefully reduce the costs in terms of liquidations.
Great. So I do not see any further questions. Oh, wait, hold on. I have two new ones. Nope, those are done. One more. That's more a restaurant and catering question on how to deal with COVID-19 and with no certainty of cash flow until we're all allowed to open, it is one of the reasons why we're having this webinar and why we're providing this advice, because there is a lot of uncertainty. And the Treasurer has given many indications that he is not going to extend the insolvency protections, that he expects that 25% of small businesses in Australia will close. It's almost as if he wants them to, which is very unfortunate. But the issue is that the government is saying that they cannot keep businesses trading that may not actually be solvent. So we've heard many cases of businesses that have actually turned in their lease and no longer occupy their premise. However, they continue to exist as an entity to collect and pay JobKeeper to their employees and are not paying other creditors. This is going to come back to haunt them in 2021 because it is highly illegal, because you're not a going concern if you do not have a premise to practice your trade. In addition, there's also some questions which I'm sure that we may or may not have answered today about the difference between the landlord code of practice, which in many jurisdictions will go until the end of March, certainly in certain states. However, when the insolvency provisions end, you may not be able to be evicted by your landlord, but they may be able to wind up your company because of unpaid rent, because they're still a creditor. So there will be a lot of questions coming into the end of the year, in addition into the new year. But this is why we are having this webinar now. It is very important. If you believe that you are trading insolvent, if you believe that you will not be able to recover, if you will not be able to pay your bills at and when they're due after the 31st of December, that you will be responsible to make that decision. And yes, you may be able to seek recourse in the case of Victoria against the government or the state, or that will be the prerogative of attorneys and class actions, and that's a whole different discussion. However, the federal government is going to be very strict, we believe, come 1 January if businesses have not entered into agreements or tried to restructure their businesses in advance of the new year.
And Wes, could I just add to that, if I could? Well, insolvent trading is a big deal in terms of it is a breach of your duties, and there is an obligation for you to cease trading if you are insolvent. But in reality, from a practical perspective, I'm, as a liquidator, only one of the many threats to your personal asset position. There's personal guarantees. Those creditors that you're not paying are less likely to enter into moratoriums or negotiations for instalment payments if you're going to leave them hanging until the last minute and you've been collecting all these cash flow bonuses and using them without paying your creditors. You know, and the landlord, most landlords have personal guarantees. And I've already mentioned the ATO. The ATO is happy to help businesses who engage with them and talk about restructuring or negotiating payment terms and installment arrangements. They're very reluctant to engage with businesses who stick their head in the sand and continue to collect the cash and do nothing with it, and then come 1st January suddenly wind up or just walk away. It's not a good option.
Yeah, so this is again one of the main reasons why we are having this webinar, and we will continue to engage with CPA Australia as well as these wonderful panelists for any continued questions that you may have about administration or restructuring or insolvency as the protections expire. So cognizant of time, if there are no more questions, which I do not see any, hold on. David Gregory is letting us know that where there are lease challenges, the Small Business Commissioner can assist in mediations with landlords, which is absolutely true. The Landlord Code of Practice and the Retail Leases Act of each state is a different process. Certainly, if your only overdue creditor is your landlord and you are in a state where you are protected, there are some protections available to you, and you certainly should have already negotiated an outcome with your landlord long before 31 December when the insolvency provisions expire. Yes, we will have this webinar recorded and it will be available on the Restaurant and Catering website in the membership area. And just checking to see if there are any more questions. There are not. Okay. Well, I very much appreciate both of our panelists, Shabby and John, and thank you for all of your insight, and thank you to all of the participants in this webinar, and check this space for future webinars about administration and insolvency as we get closer to 31 December.
Thank you.
Thanks,
Thank you for
everyone.
the opportunity.